Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and I have Jesse and Andrew with me, and we're looking forward to updating you on our September webcast. And so we've called this webcast Focus on Valuations, and we think at this point in terms of the market, the issue of valuations is becoming very important. We'll be talking to that on a number of our slides as we get through our presentation. You'll, at the bottom of the link that you're on right now, you can access the actual presentation. But in a few moments, I'll put the presentation up and then we'll start working through it for you. Okay, so let me just point out that the first slide, and let me just start to share screen right now for you. The first slide, which I'll just mention quickly, which is an important one, and that covers off our disclaimer. So what you have on the screen right now is our disclaimer, and that's important from a legal perspective. Please look at that and read that when you have a chance. I know it's not that exciting, but there you go. In terms of the outline of our presentation, just quickly, an update on our own firm, and we've got an announcement in terms of our own company. And again, just remind you of the investment challenges, key issues for 2020 and beyond. And then we're going to talk to the issue of excessive valuations and what that means for investors and how we are approaching that in terms of protecting your capital. Strategy and positioning, just a quick word about that. And then I'm going to turn it over to Jesse to talk about Wheaton Precious Metals. That's that WPM there. We love the stock codes. And then Andrew's going to talk about CGI after that. And then if you have questions, then we'll be more than glad to deal with those. In terms of ROCKLINC, just an update. We've had a very good year in terms of growth. We continue to add new homes, new households almost every week. We're sitting around 175 million in about 145 households. So we appreciate the support and the ongoing growth in the business. As you know, we focus on customized portfolios and thinking differently, not just following the crowd, but thinking differently in terms of the market opportunities. And so we talk to this issue on every presentation, so I'm not going to belabor the point. Right at the bottom of this slide, I just want to mention that we have hired a new person to our company, Braden Van Dyke. He'll be starting next week, and we'll be introducing Braden to our clients over the next number of weeks. And that's simply because we need more horsepower with the growth in the company. We want to focus on both administration and also client-facing services. So looking after our clients, more and more interaction and developing relationships deeper. And so we're very excited that Braden will be joining us. And as I say, you'll be learning more about him in the days and weeks ahead. In terms of our investment philosophy, we go over this all of the time. And so I'm not going to talk too much about this other than to say, look, we're trying to buy great companies. We focus our attention on a few businesses. We believe less is more when it comes to investing and understanding those companies. We try to be very tax efficient, which is important, and that's through tax deferred compounding. But the number 4 there I've highlighted, we try to buy at a margin of safety. And this gets back to the whole issue of valuations. And so we'll be talking about that more in the presentation. And we, of course, keep an eye on the economic backdrop. I'll also mention a couple of things about that in a few moments. Investment challenges, these haven't changed from the last time that we spoke or the time before that, and probably the time before that. And these are long-term systemic issues in the global economy. So we have excessive global debt. That's only been made worse, as we know, from the lockdowns and the whole response to the coronavirus. We have massive unfunded government promises that keep escalating. We have tremendous demographic problems that actually over the last year have become quite a bit worse. The birth rates within the Western countries, Canada, United States, Europe, and so forth, have just plummeted. And that's also going to cause problems in the future. If you don't have children, you don't have a future. And it's very hard to offlay expenses when you don't have anybody to pick them up. Monetary policies, these continue to be aggressive, printing money and record low interest rates. In Canada, we're printing 5 billion a week, so a good 20 billion a month. And the Federal Reserve just said yesterday that they're going to continue printing about 120 billion US dollars per month. The Bank of England just yesterday or today, and just going back in the news, that they're going to be injecting another 60 billion pounds into their system, and that's a relatively small economy. That's not a huge economy over there, the British economy. And so around the world, we have a lot of money printing, and so again, we have to respond to that as investors. And then I just put this in again, this lockdown folly. People, this is of course a politically sensitive area, and everyone's got an opinion, and so do I. And so I'll pass it on to you. It is, I think, the most devastating and costly mistake in the history of the world, this idea that you quarantine healthy people rather than quarantining sick people. And the estimates of the costs, we are only beginning to see. And I think we need to just be patient. This is going to be very expensive and problematic as we run these costs through the system here. So estimates are talking about 30 trillion in total global losses and capital formation destruction over the next number of years. So a big issue. I do put this slide in. I put it in last time, and a lot of clients said, wow, they didn't really realize this. And so I've updated this as of September 11th. And in Canada, we've got about 9,163 people who have died as a result of the coronavirus. At least that's what the death certificates say. But if you look at that, if you go down, you say 38 million population infected. We don't know, of course. We've tested about 6 million people, 16% of the population. About 2.2% of those that are tested actually test positive. And you can go through hospitalization, the ICU recoveries and so forth. The deaths, about 9,100, 9,200 people. That's 0.02% of the population in Canada. So at the current time, you have a 99.98% of surviving this. But what's most important there is that if you look at that column under deaths in the purple, you'll see that 85% of the deaths in Canada are individuals who have been in long-term care facilities. That means there's only about 1,300 people who've died across the country in the last 5 months, 6 months, attributed to the coronavirus outside of long-term care facilities, which, as you know, are people that generally are quite, they're aged, number one, and number two, they have a number of morbidities, so that they're very risky. No one below 20 has actually succumbed to the coronavirus. And so I point that out because I think, look, we as Canadians, as investors, we need to put pressure on the government to lift a lot of these sanctions and ease up. The cost to the economy is extensive. Because I think if you realize that in Canada, every year, we lose about 5,000 people to suicides. We lose over 2,000 to traffic accidents. Influenza and pneumonia alone take 8,000 people a year, average in Canada. We're at 9,000 here in terms of the coronavirus. Cancer, up to about 80,000 people a year, and 40,000 plus a year in heart disease. So we need to always contextualize the situation here. And when we contextualize this and look at it in more detail, I think that, in my view, we've seen massive overreach on the part of the government, and this is becoming incredibly expensive and harmful to our population. So key issues in 2020 and beyond: stock market valuations are high. I'm going to talk about that. The failure of the central banks, or what we call the monetary normalization. They cannot normalize our situation. They have to keep printing money to keep this going. Unprecedented increase in debt levels. In Canada alone, we're looking at 400 billion plus in debt. We've blasted through $1 trillion at the federal level. And our prime minister in the next week or so supposedly is going to come up and come out with other just massive government spending. And we need to really shut this down as Canadians, or we're going to destroy our financial balance sheet here in Canada. The debt-bearing capacity of governments are maxed out all around the world. That's why they're printing money. And as I say, central banks are monetizing debts, or they're paying for our debts just by printing money. And you look at the numbers there, I mentioned them already earlier, 120 billion a month in the US, just reported yesterday by the Fed. And in Canada, it's 5 billion a week, about 20 billion a month. Or our economies, if we didn't have that coming in, we'd be in big trouble. Now, in terms of valuations, we are very concerned about this. That's why we carry some cash around. That's why new investors coming in, we're just being very slow in terms of the deployment of capital. So let's look at a couple of slides just quickly. This slide I've put up here is an interesting one, because it takes what they call the Wilshire 5000, or you could say just the market capitalization of public companies. If you look at the total value of public companies and divide it by the total value of GDP, the gross domestic product, the total value of goods and services that are produced in a country in a year. And this is based upon the US. Generally speaking, once you go above 1 to 1, so that means the market capitalization value would be equal to the total value of the GDP, or the production in the country. You go above 1, it tends to get expensive. The market, you're tending to pay up for things. You can see back in the dot-com bubble, going back to 2000, we were at 1.37. That means that the stock market valuation was 37% higher than the gross domestic product value within the US. Currently, at the end of the second quarter, and we're a little higher than this now, we're about 1.52 times. So we're over 50% above the value of the GDP. And this is, again, just a benchmark. You always got to get into the details. But as a benchmark, the market as a whole is quite expensive. If you look at the price earnings ratio, which is a good, quick and dirty way to look at valuations, you can see here on this chart that the valuations, if you look at the orange there, which is the Russell 2000, which gives you a good mix of smaller cap companies. And you can see that the price earnings ratio is really skyrocketed up. Now, part of that is because earnings have come down because of the coronavirus shutdowns. Companies are under pressure. It's been to the advantage of some firms, but most firms have felt a negative impact. And you can see that that price earnings ratio has really jumped to more than 30 times, 33 times to be exact. The S&P 500, which is the big capitalization companies in the US, which includes a lot of the big tech companies, which have actually been advantaged by the lockdowns. You can see that that's trading in the dark blue there at over 18, close to 19 times plus. And generally, the long-term average is about 15. So you're starting to see, hey, this is not a cheap market. We need to be careful. This slide here I found very interesting. It was in a presentation on done by Russell Investments. And it looks at the concentration of companies in the S&P 500. And if you look at this chart, if you go back, if you look at the left side there, you can see back in 1999 when we hit a very high point in terms of valuation in the market, that the top 5 companies were about 16.6% of the total value of the big 500 companies in the United States. So you've got basically, 1% of the companies being 16.6%. Now, if we fast forward to the second quarter of 2020, the top 5 companies now represent 21.7%. So you're getting a real skewing of value. And what's interesting, when I went back and looked at that 99 list, Microsoft is the only one there that's now in the top 5, 21 years later. And it's actually gone up about 5 times, about 400%. General Electric is down 80% in the last 21 years. Cisco is down about 40% in the last 21 years. Walmart has actually doubled. Walmart's continued to do well, as most people know. And ExxonMobil, which used to be one of the largest companies in the Dow Jones and S&P 500, is actually down over the last 21 years by about 20%. So you have to really be careful what companies you buy. You just can't buy and hold indefinitely. You have to constantly be tuning the portfolio to the best companies. On the far right, if you see year-to-date return, if you go to the bottom section there, it says market cap comparison, and this is as of the end of June. What I want to point out there is that by the end of the June, the S&P 500 was at 50 index, the top big companies, was up about 2.9%. So it was actually up a little bit. And then, so you can see the larger companies, the top 50 within the 500 did well. You can see that the S&P 500 overall was down 3%. But if you were to equal weight all the companies, so you take all 500 companies and give them an equal weight rather than putting, the big guys like Apple or Amazon or Microsoft, and those are obviously going to skew the index because they're the big companies are, they're $1 trillion, $2 trillion in value. But if you equal weight, you actually see the market's down 10%. So there's very high valuations in some areas. And it's also saying that, hey, a lot of other areas in the market have not done as well. And of course, that's where we want to try to focus our attention. This is just a quick valuation comparison I put up here for you. One of the areas that we invest in quite heavily is infrastructure. We like infrastructure because it's hard assets, good dividend yields, a lot of free cash flow, and they trade at much better valuations. Even though many of these infrastructure companies are growing anywhere from 5-6% up to low double digits. So you're getting good growth in many of these infrastructure companies. But if you take a look there, you can see that the free cash flow yields are fairly decent. You're talking 5, 6, 7, 8%, which really allows good dividend payments and good reinvestment opportunities for these companies. The enterprise value, you see that EV, and I apologize for some of the these acronyms, but the EV means the total value of the business when you look at equity and debt divided by their cash flow, the EBITDA. You can see those multiples are generally 12, 15 times. If you go over to the other side, the technology, and we like Apple, we think it's a great company, you can see that it's certainly much better priced than the ones below it. That's Apple's the first one there, AAPL. And you're actually getting a free cash flow. It's a very rich and very profitable company. So it's producing a free cash flow yield of about 3.5%. And that's not a bad return for a company like Apple. And in terms of its multiple, it's trading about 20, 23 times cash flow. Now you go down that list and you look at our favorite company not to own, although it's gone up a lot. We see a lot of risk in the company, Tesla. Tesla has, basically doesn't generate any free cash flow and trades at about 100 times its EBITDA, which is cash flow before taxes and depreciation and so forth. But it's just a massive multiple. In fact, when Tesla just reached a recent high, the total value of the company was equivalent to the number of cars they sold in this year, multiplied by $1.3 million. So they were actually you were paying $1.3 million per car of production. And just to put that sort of in perspective, the value of Tesla was more than VW and VW and Toyota, which are the two largest ones, and the American cars, American manufacturers, GM, Ford, and Chrysler, and so forth, all put together. So very, very expensive. I mean, good old Elon Musk has to take over the world to justify that kind of valuation. Then you can see the value of Netflix. It doesn't generate any cash, any free cash flow, excess cash flow, and Adobe and NVIDIA, which are again trading at massive multiples. And these are great companies, not putting them down, but it's just